Understanding Howard Marks, the master of risk and market cycles. Howard Marks is one of the most respected and influential thinkers in the world of investing, not because he predicts the future with precision, but because he understands the present with unparalleled clarity. His approach is rooted in one profound belief: financial success is not solely about what you buy, but about how well you understand the risk you are taking. While many investors obsess over returns, Marks focuses on the hidden forces that shape those returns: market cycles, investor psychology, and changing risk environments. Born in 1946 in New York City, Marks grew up fascinated by probability, patterns, and how people behave in groups. He later studied at Wharton School and earned an MBA from the University of Chicago, a place famous for its focus on efficient markets. But Marks would come to challenge the idea that markets are always rational. In fact, he built his entire investment philosophy on the belief that markets are often irrational, driven more by emotion than logic. And for those who can think differently, that irrationality creates opportunity. Marks began his career in fixed income and distressed debt, areas most investors avoided due to uncertainty. But uncertainty is where risk lives, and risk is where mispricing happens. If returns represent the visible surface of the market, then risk is the unseen undercurrent that determines who truly benefits in the long run. Marks learned early that superior investing requires not extraordinary courage, but informed caution. This caution doesn't mean avoiding risk, it means understanding it better than others do. Risk is the most important thing, he often says, and he wrote a famous book with that title that became a roadmap for thoughtful investors around the world. Marks co-founded Oaktree Capital Management in 1995, a firm built on distressed debt, credit strategies, and deep value investing. Oaktree has since grown into one of the most trusted asset managers in the world, known not for flashy predictions but for consistent, disciplined risk management. While some investors want to be heroes who call the market top or bottom, Marks prefers to observe the market cycle, the recurring rhythms of fear and greed that shape valuation. In his view, understanding where we stand in the cycle is more important than trying to time every move perfectly. Market cycles, according to Marks, are the consequence of human behavior. Optimism rises, valuations expand, investors become reckless, and eventually reality brings everything back down. Then pessimism takes over, prices crash, fear dominates, and eventually opportunities emerge. This cycle repeats endlessly because human nature does not change. Marks sees investing as a battle against our own instincts. Most people feel comfortable when markets are soaring and terrified when they crash. But as he famously writes, the most important investment decisions are not what to buy, but how much to buy. When fear dominates, assets become cheap, and that is precisely when the biggest returns are forged for the future. Marks believes that each moment in the market reflects a balance, or imbalance, between risk and reward. When the potential reward is high and risk is low, opportunities are abundant. When reward is low and risk is high, danger lurks behind every rally. The real challenge? These moments are rarely obvious. They only appear obvious after the market turns. That's why Marks champions second-level thinking. First-level thinkers follow headlines. Second-level thinkers look beneath the surface. First-level thinkers ask, is it a good company? Second-level thinkers ask, is this a great company at the wrong price? Or perhaps, is this a struggling company that the market has priced for disaster, but could recover dramatically? It is in these subtle distinctions where money is made. Marks emphasizes that risk is not measured by volatility, despite what textbooks say. Real risk is the possibility of permanent loss of capital. When investors confuse volatility with danger, they often sell at the worst possible moment. True professionals, as Marks argues, understand that volatility is simply the price you pay for opportunity. Markets rise only when uncertainty fades. Profits rise when uncertainty is high. Investors who seek comfort pay for it with lower returns. The hallmark of Marks' philosophy is risk-adjusted thinking. He says earning high returns during reckless bull markets is not a sign of talent, everyone makes money when the tide is rising. The real test of skill is how well you protect capital when storms hit. His greatest success stories came not from incredible winners, but from avoiding devastating losses. Oaktree famously raised billions during periods of crisis because they were disciplined enough to wait while others rushed to chase returns. When the global financial crisis hit in 2008, Marx didn't panic, he saw the moment he had been preparing for. Assets were selling for irrationally low prices. As investors dumped everything in fear, Oaktree bought aggressively. Years later, those investments produced enormous gains. That was risk management in action, not avoiding the downturn, but capitalizing on panic. To Howard Marks, the crowd is both dangerous and predictable. When the crowd believes nothing can go wrong, disaster is closer than ever. When the crowd believes nothing will ever recover, opportunity is at its peak. He believes that the best investors are not fearless, they are simply less controlled by fear. Marx also stresses humility. No one, not even the smartest investor in the world, knows what will happen. The markets are too complex, too irrational, too influenced by unexpected events. So instead of pretending to predict the unpredictable, Marx focuses on probabilities and positioning. It's not about being right. It's about increasing the odds of a favorable outcome. Howard Marks writes regular memos to clients, legendary essays that are studied by top investors including Warren Buffett, who once said that when Marx writes, I always open it first. Those memos helped countless investors navigate market bubbles, credit crises, and shifting cycles. And the message is always consistent, risk is invisible until it hits. Preparation must come before danger, not after. What makes Marx so unique is that he combines rational analysis with emotional intelligence. He understands that markets are driven by hope, fear, envy, ignorance, and overconfidence. And if you master psychology, you are already ahead of most investors. Marx's investment philosophy can be summarized in a simple paradox: to succeed, you must think differently from others, but only when you are right. Boldness without insight is disaster. Insight without courage is useless. The world sees investing as a competitive arena, but Marx views it as a test of wisdom. That wisdom begins with recognizing one truth: risk is the price of reward. But unmanaged risk is the cost of ruin. Marx built his career on that balance. And in doing so, he became the master of market cycles. The art of assessing risk and market cycles. Howard Marx's philosophy does not stop at the simple notion that markets fluctuate. He urges investors to ask deeper questions. What drives those fluctuations? Why does the market move from euphoria to panic repetitively? And how can an investor prepare rather than react? His answer lies in a concept he calls second-level thinking. Most market participants act on surface-level observations. When stocks rise, they assume they will keep rising. When stocks fall, they assume doom is inevitable. This short-term, emotion-driven mindset amplifies volatility and distorts valuations. Marx argues that the true edge in investing comes from recognizing what others ignore, understanding not only what is happening but why it is happening and what is already priced in. Second-level thinking asks, what does the market think? And why might that thinking be misguided? By challenging consensus, investors can better assess real risk versus perceived risk. In his memos, Marx explains that risk is highest when investors feel safest because optimism leads to overpaying and reckless behavior. Conversely, risk is lowest when fear dominates, as panic pushes prices far below intrinsic value. Most people emotionally respond in the opposite way. They avoid buying when prices are cheap and rush into markets when prices are expensive. This behavioral trap contributes to Marx's greatest teaching, the cycle of investor psychology. Markets swing like a pendulum, constantly shifting between optimism and pessimism, greed and fear, confidence and panic. Marx identifies multiple cycles, economic cycles, credit cycles, valuation cycles, and emphasizes that each of them is ultimately shaped by human emotions. Consider the credit cycle. When times feel good, lenders relax, borrowing expands, leverage rises, and asset prices inflate. Eventually, that lenience creates fragility, companies become overleveraged, and even a small negative shock can cause a wave of defaults and panic selling. The cycle then reverses, credit becomes scarce, fear rises, and prices collapse, often beyond what fundamentals justify. Investors who understand this rhythmic behavior can avoid disaster and position themselves to profit when others retreat. Marx repeatedly reminds investors that you can't predict the future, but you can prepare for it. Preparation comes from recognizing where we stand in the cycle, not through exact forecasts but through probabilistic thinking. Are investors overly confident? Are credit spreads too narrow? Are valuations stretched? If the answer is yes, the prudent investor raises caution and prioritizes capital preservation. Conversely, when markets look distressed and others feel hopeless, opportunities emerge. Marx has often been bold during times of chaos. The global financial crisis of 2008 is one example when Oaktree bought distressed assets aggressively while others were paralyzed with fear. Marx's contrarian moves were not reckless gambles, they were informed by careful risk assessment. He would say, "If you wait for the dust to settle, the bargains disappear." Howard Marks often refers to the role of luck in investing. No strategy or skill can completely remove uncertainty. Even the smartest decision can result in short-term losses, while irrational risks can deliver temporary rewards. The key is recognizing that short-term outcomes don't always reflect the quality of decisions. The best investors judge success not by a single result but by whether they consistently make decisions with strong reasoning, patience, and discipline. One of Marx's most valuable insights is the difference between risk and volatility. Many investors believe volatility equals risk. When prices move quickly, they feel exposed. Marx argues the opposite. A temporary price drop does not create real risk unless the investor is forced to sell or the business itself deteriorates. True risk is the possibility of permanent capital loss, not short-term market fluctuations. This mindset separates investors from gamblers. Those who fear volatility sell at the worst moments and lock in losses, while long-term thinkers recognize volatility as the price of admission for superior returns. Howard Marks also teaches that superior returns can only come from non-consensus behavior. If you invest like everyone else, your results will match the crowd, average at best. To outperform, one must seek opportunities where the majority is wrong. That means being comfortable with disagreement, criticism, and uncertainty. A truly great investor is emotionally resilient. They don't panic with the herd nor celebrate too early in euphoric times. They seek truth in data, fundamentals, risk management, and cycle positioning. Marx says, daring but cautious. That is the mindset. The market, in his eyes, is a never-ending battle between emotion and rationality. And unless one can master internal psychology, fear, impatience, envy, the market will always win. Investors often chase returns because others are making money. They forget their strategy, lose discipline, and become victims of the current cycle's illusion. Understanding cycles allows investors to avoid extremes. Marx emphasizes that investing does not require perfect timing. It requires better timing than the crowd, enough to stay ahead in the long run. His memos are full of warnings. When optimism dominates headlines and promises of a new era appear, skepticism is crucial. When headlines predict a full collapse and people say, this time is different, courage is necessary. Howard Marks once wrote, the biggest investing errors come not from what you don't know, but from what you think you know that just isn't true. This belief keeps him humble, always researching, always questioning, never assuming invincibility. His philosophy integrates analytical skill with emotional discipline, equal parts mathematics and psychology. Marx encourages investors to seek asymmetric opportunities, situations where potential upside greatly outweighs possible downside. This approach reduces the need for heroism or risky bets. Instead, investors patiently accumulate advantages that compound over time. Through decades of observation, Marx has crafted a mindset focused on understanding cycles before they become obvious, evaluating risk when others ignore it, maintaining discipline when others lose theirs, and positioning capital to benefit from irrational market behavior. In summary, Howard Marks teaches that success in investing does not belong to the boldest nor the smartest, but to those most prepared for the shifts in market psychology. Second-level thinking and deep risk understanding allow investors to survive storms, exploit panic, and build wealth steadily. His philosophy empowers us to see the market not as chaos but as a system of behavior patterns, patterns that repeat, patterns we can learn from, and patterns we can use to our advantage if we remain rational and resilient. Mastery of investor psychology, Howard Marks' legacy for the future. Howard Marks's teachings reached their peak in the realm of investor psychology, the silent force that drives markets far more powerfully than any economic model or algorithm can measure. He believes that while numbers are essential, it is human behavior that determines outcomes. Fear, greed, envy, pride, impatience, these psychological forces shape decision-making and create predictable outcomes in a system many believe to be chaotic. In his world, understanding humans is understanding markets. Marks's philosophy is like a shield against emotional mistakes. He encourages investors to ask themselves not just what the market is doing, but why they feel compelled to act. Are you buying because the business is strong and undervalued, or simply because others are making money and you fear missing out? Are you selling because the fundamentals have deteriorated, or just because headlines are terrifying? Marks teaches us that self-awareness is a competitive advantage in investing. Most investors think the battle is against the market, but the true battle is against themselves. Patience versus fear. Conviction versus doubt. Rationality versus emotion. And in this internal war, those who manage their feelings win. His philosophy focuses deeply on cycles of emotion, which mirror the cycles of credit, valuation, and economics he often writes about. However, the emotional cycle may be the most powerful of all. When prices rise gradually, investors feel comfortable, then confident, then euphoric. Each step encourages higher risk-taking, more leverage, more speculation, more, this time is different, thinking. Eventually, pressure builds until reality strikes. Prices drop, egos shatter, fear explodes. Those who once shouted bold predictions now rush for the exits. And finally, despair sets in, just as true opportunity emerges. Marks states that the key to long-term success is recognizing which stage is unfolding and acting contrary to the crowd. To execute on this insight requires emotional discipline, one of the rarest qualities in financial markets. His famous quote, "The biggest investing errors come from psychological mistakes," underlines his belief that avoiding behavioral traps is more important than chasing returns. He encourages investors to have a clear philosophy, a strategy grounded in rationality, not trends. At Oaktree, this philosophy centers on distressed debt investing, buying when others are fearful and liquidity is scarce. This strategy has made Marks one of the most respected figures on Wall Street, admired not only for his knowledge but for his humility. Marks frequently emphasizes humility as the main ingredient of longevity in investing. The moment an investor believes they know, they have already lost. Markets exist to humble arrogance. He argues that the best investors operate under the assumption that uncertainty is permanent. And that luck plays a meaningful role in every outcome. This humility leads to risk-conscious thinking, a foundation of all his writings. Unlike those chasing brag-worthy returns, Marks believes superior investing is not about swinging for home runs, it is about achieving great results while exposing capital to the least amount of risk possible. Over decades, this mindset compounds into extraordinary success. Howard Marks's memos are the heart of his legacy. Written with sharp intelligence and rare clarity, they decode market behavior in real time. Buffett himself once wrote, "When I see a memo from Howard Marks, I read it immediately." Such praise reflects the value of Marks's ability to transform complex concepts into practical wisdom. His memos stand as historical navigation guides, telling future generations not only what happened but why. In these memos, Marks describes cycles, risks, herd behavior, value discipline, and investment humility. But he also warns against the greatest temptations of modern finance, speculation disguised as innovation. He warns investors not to mistake momentum for safety or novelty for value. Marx's teachings are especially critical today, as new generations face rapidly changing markets, crypto volatility, tech bubbles, meme stock culture, and AI-driven speculation. His message remains consistent: don't get swept into euphoria, don't get lost in despair. Know the cycle. Know yourself. The future of investing, in his view, depends not on predicting the next technology but on developing timeless skills, discipline, critical thinking, emotional control, and adherence to a philosophy that protects capital through every part of the cycle. That is why his book, The Most Important Thing, does not point to a single concept but reveals dozens of most important principles. Investing, he argues, is far too complex for one answer. Instead, it requires a mosaic of insights, risk management, contrarian thinking, probabilistic judgment, patience, and humility, all working together. The true goal is to constantly sharpen judgment, not to seek shortcuts. The world of finance often celebrates boldness and aggression, yet Marx celebrates restraint. While others focus on how much they can make, he focuses on how much they can lose. This unusual lens is what separates those who survive decades from those who disappear after a single cycle of overconfidence. The core of Howard Marx's legacy is a simple but profound message: investing is not about winning all the time, it's about avoiding losing big. Protect the downside, and the upside will take care of itself. His work empowers investors to face volatility without fear, to embrace uncertainty with structure, and to act rationally when the world is irrational. Howard Marx teaches us that mastery in markets comes from understanding that success is behavioral, not emotional. It is strategic, not impulsive. It is patient, not hurried. And most importantly, it is earned through discipline, not luck. His impact on finance will endure for generations because his principles are timeless. Cycles will continue, greed and fear will continue, mistakes will continue, but those guided by the wisdom of Marx will navigate the future with clarity others lack. As long as markets exist, his teachings will remain a compass for those who wish not only to profit but to invest wisely. Howard Marx has shown us that the market's greatest reward goes to those who understand not where the cycle is going, but where they stand within the cycle. When others chase excitement, Marx chooses caution. When others panic, he sees opportunity. And that, he tells us, is how true wealth is built, quietly, rationally, and with profound respect for the nature of risk. In the world of investing, fortunes are not made by luck or chance, they are built through discipline, patience, and understanding. Howard Marx has shown us that the key to long-term success isn't predicting the future, but preparing for it. If you want to become the kind of investor who thrives through every market cycle, then keep learning, keep questioning, and keep your emotions in check. Thank you for watching and exploring the wisdom of Howard Marx with us. If you enjoyed this video and want to dive deeper into the philosophy of legendary investors, don't forget to subscribe to our channel. Join us on this journey toward smarter investing and financial freedom. See you in the next episode.